Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Zwan, and in each episode I share my thoughts with you on a topic or a recent development in South African tax. And I try to keep the episodes short enough that you can listen to them whenever you've got a few minutes in your calendar. I would like to ask you, if you like the podcast or even just this episode, to consider sending the link to the podcast or the episode from your podcast player to any other person who you think would also be interested in listening to the podcast. If you do this, you help me to grow the listener base, and I guess that's always good for any podcast. We are talking about trading stock today, and specifically how to value trading stock, your closing stock, for tax purposes. Now, those of you who have followed and who follow case law quite closely would know that there were a few cases over the past number of years, actually a few years ago. Firstly, the Volkswagen case, and then the Atlas Copco case. And I think if we can take the high-level message from these cases is that the value of closing stock for tax purposes is not the same as the value for accounting purposes. So accounting requires that you value your stock at the lower of cost or net realizable value, whereas there's a different rule for tax. So what does the tax law say? In the case of trading stock, and we find this in section 22.1 before I start going into the detail, 22.1 states that in the case of trading stock, other than trading stock as contemplated in paragraph B, so that's some financial instruments, the cost priced to such person of the trading stock, so in other words, you value your trading stock at year end at cost, less such amount as the commissioner may think just and reasonable as representing the amount by which the value of such trading stock, not being any financial instrument, has been diminished by reason of damage, deterioration, a change in fashion, a decrease in the market value, or for any other reason that's satisfactory to the commissioner. So let's maybe just quickly recap how exactly does this provision on closing stock work. So if a trader buys stock, there's a section 11A deduction for the purchase price of the stock. But then if the stock is unsold at year end, so if it's still held by the taxpayer at year end, section 22 requires that the value of closing stock be added back. So if there's no decrease in value, then your section 11A deduction would be neutralized by the closing stock inclusion, and this closing stock inclusion becomes your opening stock deduction the next year. And so this deduction keeps rolling forward, and it really only materializes in the year in which the stock is sold. The relevance of section 22.1 then is to say, but if you've got unsold stock at year end and there's a diminishing, so the value has been diminished for some reason, then essentially the difference between your 11A deduction, what you paid for the stock, and what the stock is worth now, that difference, the decrease in the value of the stock, you can actually then claim that as a deduction in this year, even though you haven't sold the stock yet. So that's really, in simple terms, what section 22.1 does. I think if we read section 22.1, it's fairly clear that there is a discretion for the commissioner, and this discretion is one of these discretions that, if it's exercised by SARS, it is subject to objection and appeal. Now, let's go delve into how do you determine this reduction in the value of your trading stock in a bit more detail. Now, for a long time, Practice Note 36 was the authority that SARS issued on that. This practice note was issued in 1995, so about 30 years ago. And interestingly, even 30 years ago, the practice note starts off by a statement to say that there are various questionable methods that taxpayers are using to write off stock. It then goes into a bit of detail to say what's acceptable, what not, what would be required of a taxpayer. The first point it makes is that you can't just do a fixed percentage write-off. So you can't just write off 20% at the end of the year. That's not what Section 22(1) allows. The crux of what in Practice Note 36 said was that where the stock was not valued at cost, so in other words, it's been taken into account as closing stock at a lower value, the taxpayer is required to reveal this to the receiver of revenue, as SARS was back then, to submit reasons for this and indicate how the lower value was arrived at, and if it wasn't the actual value that was used as the basis for the reduction, if it was some sort of a fixed variable or other basis, it was up to the taxpayer to justify that basis to SARS. So that's really the essence of Practice Note 36. Why we are talking about this topic today, Practice Note 36 was recently withdrawn and replaced by Interpretation Note 140. So I would like to highlight a few things from this interpretation note. The first thing is that the focus of the interpretation note is to make it very clear that what you can get as a reduction is the diminution in value of your trading stock. So in other words, the value of your trading stock had to decrease. So that means and in principle, you calculate the decrease as the cost minus the value of your stock now. So if the value of your stock now isn't less than the cost, then there is no reduction under Section 22(1). What SARS indicates in the practice note is whether the value has diminished or not is a question of fact at the end of the year. They are not prescriptive as to when and how it may be, seeing that I'm sure that there's various types of stocks, various industries, so it's very difficult to be prescriptive. What the interpretation then does is it considers the meaning of what damage would typically be, what deterioration would be, changes in fashion, and decreases in market value. It then also talks about the last category to say that if there are other factors that cause the decrease, so not damage, deterioration, changes in fashion, or decreases in market value, that is something you need to consider on a case-by-case basis. What it does make quite clear is that it's not net realizable value write-offs. That's not what is being contemplated. What the interpretation then also makes quite clear is that the taxpayer bears the onus of proof to show that the value of the trading stock is actually less than the cost. The last point about value reductions or decreases in value that the interpretation note also touches on is to say the timing of when that event that causes the reduction in value occur. And it says that the event must have either already occurred or it must be a reasonably certain event that will still occur. So it's really something that you already need to know that the value of the trading stock has gone or will go down. Right, the last point that the interpretation note also touches on is the question as to do you need to write off on an item-by-item basis or a category basis? Now, Proviso 2 specifically deals with, and it was specifically introduced to allow for write-offs of specific items, even if the category's value is more than its cost. So in other words, if you've got a whole category of stock, the value of the category exceeds the cost, but there are some items in there that are, for example, damaged. Proviso 2 allows you to write off the damaged items to a lower value. What the interpretation note then goes on to say is the decision, do you do the write-off on an item-by-item or category basis? Otherwise, that depends on the facts and circumstances. So if you, for example, got high-volume, low-value items, it might be sensible to look at the category of stock and to determine the write-down. Whereas if you've got unique items or low volume, high value items, you could actually consider the market value or the value of each item individually. So it depends on the facts and circumstances whether item for item or category based write-offs are appropriate. So to conclude, I think the few points you can take home. First point, Practice Note 36 was replaced by Interpretation Note 140. The Interpretation Note contains a lot more detailed guidance about these write-down factors than Practice Note number 36, and the burden to prove that there's been a diminution in the value of the stock is clearly on the taxpayer. Right, that's that for today's episode. If you've got any questions, comments, please send me an email. My email address is in the show notes. As always, I just want to remind you that nothing in this podcast is intended to be tax advice. The podcast is only for information purposes. Until next time, goodbye.